Thank you very much, Adrian. Thank you, everybody, for joining us here today. I'm very proud to be your speaker. Basically, for the next few hours, you might get sick of seeing my face or hearing my voice, but you're going to have to deal with it. This particular panel is ESG Investing, a bridge to reach the SDGs. And how far or short are we on both product development and product uptake? And I'm very pleased to have three panelists join me today. Unfortunately, Pedro informed us that he is not available to join us today and sends his regrets. So I will serve not only as moderator, but perhaps panelist, judge and jury, if you will. We're going to start by giving you a little bit of a background on each one of us so you can see the different perspectives we're going to attack this very critical topic from. As Adrian said, I am very fortunate to be the President and Chief Investment Officer of Hennion and Walsh Asset Management. We're located right across the pond, and I don't mean London, I mean New Jersey in this case, in beautiful Parsippany, New Jersey. As she said, I'm a frequent member of the media. You may recognize my face or my voice. I've been told I sound like the American actor Ray Romano, so I can't control that. But I am a regular on CNBC on shows such as Squawk Box, Power Lunch, and The Exchange. I was on Power Lunch just last Thursday. Also a regular on Fox Business News. In fact, I'll be back on Fox Business News tomorrow afternoon at 2 p.m. if you want to tune in and check me out there. I'll look a lot younger. They put a lot of makeup on, so that certainly helps. I've also written an academic book on exchange-traded funds. I write for Forbes, Seeking Alpha, Talk Markets. I've been published in the Journal of Investing, the Journal of Index Investing, and in my spare time, I raised two daughters with the help of my wife. So that's a little background on myself. In terms of my connection to this particular topic, I am the Chief Investment Officer of Smart Trust Unit Investment Trust, and our flagship product is our own Sustainable Impact Investing Trust, where we blend the ESG-oriented ratings of Just Capital. If you're not familiar with Just Capital, they're led by CEO Martin Whitaker. On their board is the likes of Deepak Chopra, Arianna Huffington, Paul Tudor Jones, and they approach stakeholder capitalism from a very different angle, which I'll get into during the panel. We also incorporate the investment ratings of Argus Research. So we blend ESG-oriented ratings with investment ratings to develop a portfolio of companies that we believe clients can feel comfortable with, and hopefully the returns of those stocks that they can also be pleased with. But enough about me. Let's get to the rock stars now. Let's have each one of the panelists introduce themselves. Tap, would you like to start?
Kevin, thank you very much, and good afternoon to everybody. I'm sorry I couldn't be there in person, even though I'm only across the pond as well in Jersey. I'd hoped to dash across Manhattan to make it there alive, and I realized you don't dash across Manhattan at all, so I wisely decided to do this online. I'm Sikipa. I work at the World Bank Treasury. I lead the investment strategy and sustainable investment team there. Most of you will know the World Bank for, obviously, its work in multilateral development. On the investment side, we manage something in the region of close to $200 billion, of which a significant chunk, we would say, is attributable to what we would call very much the ultimate impact investors. So we're very keenly invested in looking into the idea of sustainable investment and kind of channeling funds towards that. So I'm very much looking forward to listening to everybody else on the panel today. So thank you, Kevin, for the introduction, and on to the next person.
Thank you very much, Tap. Mathieu, would you like to go next?
Thank you very much. I'm very pleased to be with you, and I'm also sorry of not being there in person. Actually, I'm right now in Geneva, so I'm a bit too far to actually rush to the meeting. But so yeah, my background, I am actually coming from the financial sector. I used to work in a private bank before joining international organization, and I'm right now with the UN, the United Nations, working mainly with governments and the private sector to see from a regulatory point of view, a policy point of view, how can we channel more investment flows to sustainability project companies, and so how to do that. We do that both by advising, as I said, governments on their regulatory aspect, but also partnering with the private sectors and investors that are committed to this idea. And so I was working with what was called the Global Investors for Sustainable Development Alliance, which is an alliance of 30 companies supporting, launched by the Secretary General of the UN, which the goal of trying to direct more investments toward sustainability development, sustainable development projects. So very pleased to be with you, and I'm looking forward to the discussion. Thank you.
Excellent. Thank you, Mathieu. And last but certainly not least, I'm glad that he was able to join us. Travis, you want to give us a little background? Certainly we all know about CalSTRS, about yourself and your role at CalPERS, rather.
Yeah, happy to do so. Travis Antoniono, investment manager over at CalPERS, California, the largest retirement system. In fact, actually the U.S. largest retirement system, well over $400 billion. Hopefully we'll keep it under 400. We touched 500 just briefly, but I think just like everyone else, we experienced a little bit of a bad downfall. So with that in mind, we serve about 2 million different retirees and current members within the state. My role at CalPERS, I've been there for over the last year, is to really do anything related to climate change, whether that's working on policy aspects or communication team or executive team setting the strategy for the organization, or even working on due diligence for individual deals. Likewise, that also includes some of the more traditional corporate governance or ESG type of functions, working with my other peers within the organization on engagement efforts as well. And before I was at CalSTRS, I spent over a decade where I co-managed a sustainable private markets and public markets portfolio over at CalSTRS.
Outstanding. So we have the World Bank, the United Nations, CalPERS. How did I get on this panel? I'm not exactly sure, but I'm going to lend a hand and try and move this conversation along. And we're going to start with just getting an assessment of the current landscape as it relates to sustainable or SDG-oriented products. As I led with, we happen to have our own flagship product at Smart Trust, which we call our Sustainable Impact Investing Trust. And what we found is that since we launched it back in 2014, it did take time to actually penetrate and develop a following, but now, in fact, it's one of our largest product offerings that we have across the country. And I think it's less to do with ESG, and it's more to do with the risk management and the returns that those types of companies have been able to offer individual investors. I stated earlier that our approach is somewhat unique. Just Capital actually polls individual Americans and asks them to determine what issues are most important to them to define the just behavior of corporations. And they separate them out into 5 different categories, which they called stakeholder categories. First category, of course, being their employees. Second being their clients. Third being the environments that they operate within. Fourth being, of course, the environment. And finally, 5 being shareholders. Interestingly enough, each year when they do those polls, which they do announce on CNBC and publish in the Wall Street Journal, the number one most important issue, at least to Americans, as it relates to those 5 different stakeholder categories, is how those companies treat their employees. Second is, do they give back to the communities that they operate within? And I think a lot of that's been driven, of course, by the outfall of what's taken place during the pandemic. Interestingly enough, what came in last place during that ranking system was the environment. Still polled at 9%, but the lowest amongst those other stakeholder categories. And I wonder if some of that's been impacted by all of the regulatory and political scrutiny, at least of the E, and I mean energy, not necessarily just the environment, of ESG. But with that being said, I'd really like to get the panelists' view on their view of the current products available, what they think is working, what they think is lacking, and perhaps their outlook for the future. Tap, can you start for us?
Sure, happy to, Kevin. Look, I think, let me preface this by saying there are a huge amount of products out there, and sustainability need not necessarily mean SDGs, right? That term means very different things to different people. And so there's an element in which one can separate out the supply side, and the industry will always respond to what they feel people want to buy or people are interested in, and there's a huge amount of supply side product out there covering, to your point, something that might matter for someone day to day, how they treat me, or how they treat their employees, versus something which is hugely big picture. What is happening with the earth? What is happening with something else? And so what I think is very important here is to understand where the demand side is. And as long as asset owners, as long as investors are very clear about what they're trying to achieve, and then take that clarity and use it to make the right choices in terms of solutions, I don't think there's a huge mismatch there. And the good thing is the data is always improving. The technology around the way we can kind of measure things and report things is always improving. And so there's always going to be this kind of ratcheting effect of improvements in product offering, improvement in understanding of what is actually achievable. So I would say yes. To answer your question in very concise terms, there are a lot of solutions out there. They may not be perfect to every single investor out there, but I don't think we're anywhere near close to perfect in any respect in terms of sustainable development or in terms of sustainability as a whole. But the trend is going the right way. And for that reason, I would say yes, as long as, our job as asset owners, our job as investors is to keep the industry honest by, continuing to ask the difficult questions. And in that respect, then I think we're there. I think we're getting there. I think we're on the right track.
Keeping the industry honest. I love that. And the one thing I can think about, as you say, keeping the industry honest, is with respect to all the scrutiny on fund naming conventions and having ESG in the names of those various funds. Are they truly ESG funds? What are they based on? Or is it more of a black box criteria that isn't sufficiently defined and doesn't actually fulfill the goals of what those investors are actually investing in? I do believe that all that scrutiny will actually help make the product marketplace better over time, but that's a question for later. So let me turn to Travis now and get Travis's view on the current available slate of ESG or sustainable impact investing products that are out there, and perhaps from your seat, Travis, what you might like to see out there going forward.
Sure, yeah. I definitely agree with the previous comments that were already made. The first step really is for the organization, which is procuring these type of products or services, to define what sustainable investment is to themselves. That's a little bit of a different view than perhaps what others might think, because a lot of people will be looking for more of a standardization type of approach. And that's something that I think everyone will be able to champion behind, but not necessarily as realistic for it to actually arise. I think we're already seeing this differentiation between views of what sustainability is, even within states or within different countries. So if you break that out across the global type of perspective, there's obviously SDGs, but even that is a little bit more focused on the European peers compared to American peers that we have. So once you first define, what sustainable investment is, and that's largely going to be probably based upon other type of, frameworks that already exist, then you have to really focus on, is it more of a focus on process or an investment universe? Because right now, so often it's been, sustainable investments, I know it when I see it. It's green, it's solar, it has something to do with climate. It has climate in the title. Perhaps that all fits, whatever the mandate is that your organization has. But I think the real focus for us is more on the risk and opportunity capture, and focus on the outcomes instead of the inputs, or the outputs instead of the inputs. The inputs could be, the investing universe, but really we're focused on why are we even looking at these type of things? Why are we looking at sustainable investments? And the reason that sustainable investments is so important is to help mitigate these type of greater, risks, not only to our organization, but to the greater economy. And so if you're able to actually see that transition into being able to have that impact and to drive market rate returns, which is what we're focused on, then obviously you're going to be hitting a lot of different objectives that you have. As far as the products that are available, there's more products than I can actually count. And it seems like every day I have more and more emails in my inbox for solicitation. But that's good overall. But $183 billion or so is the last figure that I heard more recently, back in February or so, of the amount of capital that was either recently raised or soon to be raised for private market investments. And we saw some very, very large funds, $5+ billion, $10+ billion funds. Likewise, we've also seen a lot of capital go over to low carbon type of indexes. And then we've seen a tremendous amount of growth over in the green bond spaces as well. So it's a variety of different asset classes that are really positively getting onto this type of trend. As far as the evolution of where I see this type of thing going, I think I'll kind of echo a message that I mentioned over to some leadership over at CalPERS about 5 years ago. And this is when I was managing the sustainable public equity type of portfolio. And I said, eventually, this portfolio is going to be lifted and provided back over to the main public equity portfolio. And that's actually was my goal. And because there shouldn't be a distinguishing aspect between ESG investing or products or services compared to non-ESG investing products and services. If the focus is really on the process and the output, then there should be no differentiation. And I think we're already really seeing that, especially in the public market, as far as the actively managed fundamental public equity type of market. Slowly over time, I think we're going to be seeing that more on the private market space. And then specifically on the private market space, I think a lot of the focus is going to be over time, now that we have these type of venues to capture data, is to be focused on value creation. And that's a traditional tenet of private equity, but to be able to demonstrate that these other characteristics that maybe weren't considered before, or OPEX or CAPEX spending, is actually driving value creation, is the next demonstrable type of effect to be carried out.
Excellent. And when I often get asked the question, we have roughly 18,000 retail accounts here in the States. And when our clients ask us, okay, I understand what socially responsible investing is or was. I've heard all of the rumors about ESG. The heck is sustainable impact investing? And we try and boil that down to one synopsis, a mission statement, if you will, that they can grab and understand. And what we like to say is that it's a way in which you can have a positive impact on the world while also having a positive impact on your portfolio. Would you like to learn more? And that's a good way we think of boiling down really what has taken place with the evolution from social responsible investing through the lens of ESG, now ultimately arriving at sustainable impact investing. In other words, it's no longer mutually exclusive goals to feel good about the companies you're investing in, and also hopefully feeling good about the returns that the stocks of those companies generate. But with that, Mathieu, your perspective on what you see in terms of the current state of the available marketplace for these types of products, and perhaps even more importantly, what you'd like to see from that product marketplace going forward.
No, thank you. Thank you for the question. And I must say, I don't share the same enthusiasm as some of the previous speakers in terms of, and I think there is a clear demand from investors for sustainably aligned investment products, and I think that demand has been met by products that often lack the credibility or the robustness that people are expecting from those products. And I think that's due first because, of course, there are some issues with data. There are some difficulties in doing that. But so there has been a tendency to try to brand products that were not really doing anything in terms of sustainability as aligned with as ESG or sustainability aligned. And I think that's something that now we are seeing a backlash of, and we have been saying that for many years now. And so that's what people know. The crisis or the credibility crisis of the ESG investing market is coming from that perspective, I think. So I think from now on, what we need to do is to try to increase that credibility by differentiating between those that are, and I think that's exactly what the SEC is trying to do with the name of funding or the ESG funding name for funds. But I think that's really something we are hoping to see. And so I'm optimistic in that sense that we are now seeing some of the issues and trying to address those issues. But I think in the past there's been that big issue where you have ESG funds basically almost identical to a traditional investment fund. So in terms of portfolio allocation, with really tiny differentiation, which does not in terms of creating an impact or having a positive contribution to sustainable development, that's very difficult to argue. So I think there is a little bit of that, but I think that's slowly changing, and so that's where I think there is a very positive things happening, and I think that's where I'm also optimistic, is that all this ESG is creating more transparency, creating some awareness from retail investors, from policymakers about the contribution of private companies to sustainability goals. And last point I want to make is, we always say, well, sustainability can mean different things to different people.
Yes.
And that is true. But still, we have things like the SDG, the Sustainable Development Goals, which are a basis that has been agreed by all governments in the world. So, which is, I think, a reference that can be used for product development better than has been so far. So I'm happy to further discuss that in the next question. But I think there's this reference point that is something that could be helpful for product development going forward, if it's done in a way that is credible.
Excellent segue. Thank you, Mathieu. We're going to stay with you as a result. So what do you think is the biggest single hurdle that might impede the further progress of sustainable impact investing, and how can we overcome that hurdle? Is it merely just about education?
No, I think, well, when you see a lot of SDG type of aligned investment, often what they do is trying to look at companies that may contribute to sustainable development, and how they are trying to make that assessment. They, for instance, they look, okay, how many of your turnover of that company is in the health sector, is on sustainable energy. And so they're using basically revenue alignment as a proxy for impact, which is basically the only way that they've managed to make that kind of decision. The problem with that approach, as you can imagine, is if you're a health company, I mean, not all the health companies are doing good. Some may actually overprice patients. They might have not, or they might be focusing on things that are not linked to sustainability, like plastic surgery or whatever. So you need to complement that approach with some kind of KPIs or targets, which can measure a little bit more better the contribution of a company to sustainability goals. And I think that's one of the hurdles, and that's where there is a need for a better understanding of, for instance, what those KPIs could be and how they can be applied to different companies active in the same sector. So I think that's one way where we can make progress, and I think that's something that we will see in the future.
Very good point. Travis, I know you approach this from a climate perspective, but of course there's more to sustainability and impact investing than just the climate, albeit a very important component of impact investing. But what do you see from your seat as the largest single hurdle for sustainable impact investing? And from your seat again, how can we overcome that hurdle?
Yeah, I think there's perhaps a stigma that sustainable impact investing, this keyword being impact, perhaps does not provide market rate returns.
Exactly.
And I think that's something, that would just be like hitting on the head right there. And that's something that I see as I interact with different people across different organizations that perhaps aren't as close to sustainable investments, aren't as close to impact investing. And unfortunately, there are a lot of products that were actually marketed, that have sub-market returns as well. So there is good reason for this type of belief to persist. But at the same time, there's plenty of products that also exist, and managers that exist that provide impact investing type of disclosure or strategies that do meet or exceed market rate returns as well. So you have to dig in a little bit deeper to be able to have a clear understanding. But outside of this, I think a lot of things that I see across different peers that I have, and when I talk about this and talking about more of the larger institutional investors, is governance models, policies, risk budgets, the duration, capital recycled timelines, rate of returns, obviously. These are all the traditional factors that already prevent any type of progression from any type of emerging asset class or emerging type of thematic. But it's something that's going to be a hurdle that's going to have to be overcome. So I would instead focus more on looking at sustainable impact investing from the lens of, once again, what are you actually trying to accomplish? Is impact investing needing to be actually in the name of the product, or is it instead, should it be focused more as the byproduct of the investment? And that's really where the camp I'm in, and I think CalPERS is in it as well, is if you focus more on the outcomes, the byproduct of the investment, then if the end result is the exact same, some type of demonstrable, impact, then that's good news, and that's a win for everyone. You don't necessarily need to have, impact dedicated strategy to actually have impact.
Throw me into that camp as well, Travis. Tap, from the World Bank perspective, what can we all do collectively, whether it's asset managers, individual investors, pension fund managers, government entities, conference producers, to help further the growth of sustainable impact investing?
Look, I think, one thing I always say is I'm very fortunate to work in finance and investments, but do that at the World Bank, because it does allow me to understand that sustainable development is not this linear thing where you put in $1 and click a click, out there is the outcome. Development is messy, development is difficult. And so sometimes coming from finance, a very objective world where things were pretty well set out, to this world where suddenly you're aiming for things that may not be so clear cut, and take much longer for those outcomes to manifest. That's difficult, right? And so the message I always give my management and anyone else who us is that asset owners on our side, we've got to be willing to do the work in terms of figuring out, to Travis' point, what we want, what we mean by sustainable development. What are those metrics that are, to Matthew's point, the KPIs, but also what is actually achievable? What is something that makes sense to request? What is something that makes sense to shoot for in terms of the outcomes that we want? Because I get the sense that, some of the pushback that we've been seeing has been because people expect development to happen in this linear way, and it doesn't work that way. And staying the course in sustainable development means, being willing to do the work in terms of what development means, to do the work and have that patience in terms of the long-term outcomes that are needed, and basically understanding that there's going to be the spectrum of sustainable development. There are some things you can do in the short term, some things that are eminently achievable, some things you can link very, very easily. Other things are going to be much more difficult. So, the message I always try and put out there is you can't outsource the work in terms of figuring out what development means to you. You've got to own it, you've got to stick by it, but you've got to be willing to kind of progress as data gets better, but also understand that development doesn't work in this easily linear way. And so interrogate your kind of beliefs and thoughts along the way, just to either reinforce them or, make tweaks around the edges as the world goes on.
Tap, I'm going to stay with you and throw you into the regulatory and political crosshairs, if you will, but I'm going to throw everybody into that as well, so you're not alone. Clearly, there's been a lot of scrutiny over ESG, whether it's from the SEC, other regulators, and certainly now it's become a political lightning rod, for better or for worse. Terms such as woke capitalism, I believe, are doing a disservice to everything that sustainable impact investing really stands for, right? But I'm wondering if there's a silver lining to all of this scrutiny. Is this scrutiny allowing us to really better define what sustainable impact investing is? How energy or the climate is just one component, albeit, yes, a very critical component. Who would disagree that companies shouldn't treat their employees well? Who would disagree that companies shouldn't give back to their environments and their economies and the communities that they operate within? Who would disagree that they shouldn't have strong balance sheet? Who would disagree that they shouldn't promote a fair and equitable workplace? Certainly everybody would agree with that. So let's not allow this to become a political lightning rod, but rather work with the regulators to better define what we do, how we do that, so ultimately the investing public can feel more comfortable putting their hard-earned money into the solutions that we all provide. That's my take. But Tap, what is your take on all of that? Do you think all this scrutiny is starting to have an impact? And if so, is that impact good or bad?
I think the regulations are starting to have an impact. I think it's a very useful intervention in many cases. Just in terms of, I say, trying to kind of put guardrails around, let's say, provision of certain services, naming conventions, et cetera, et cetera. I think all of that is a very useful exercise. I also think you're starting to see a lot more, call it regulation / standardization in kind of things like, let's say in the GSS world, the issuance of certain types of bonds, et cetera, and what you can call a green bond versus a social and sustainability bond, et cetera. I think all of those are very useful interventions. Ultimately though, we will see whether or not the level of regulations that we're seeing, and bear in mind that regulation is changeable across the different jurisdictions, right? So you might get a certain type of regulation happening in Europe, for example, and a very different style or type happening in the US. Ultimately, I don't think it's possible to say that all regulation equals good. I think there are certain parts of our regulation which will help the industry, which will help investors, which will help issuers, and parts of that regulation may be actually detrimental for all of those stakeholders. Like all regulation is, right? It's difficult to get everything right when you're doing something at that scale. But to your point, if we're trying to address those large scale questions, such as is it a good thing that employees should be safe at work? Yes, of course. And so if you can put the right guardrails to ensure the direction of travel there is the right one, then yes, regulation is actually, I think, working well for investors. And to the question that you asked, working well to give asset owners as well the confidence that where they put their money is somewhere that will have the desired effect.
Good. I'm going to go to audience questions in 2 minutes, but I'm just going to give Travis and Mathieu an opportunity in 1 or 2 sentences to answer that question. Is all of this regulatory and political scrutiny ultimately good or bad for sustainable impact investing? Travis?
Yeah, right now it's really on the margins, but momentum could be a scary thing, and it could definitely continue to increase. The focus for a long time has been on these ESG type of scores, the lack of correlations that exist between different ESG score types of institutions. I think that's evident. That's just mathematical, but there is a lack of correlation existing. And instead, the focus perhaps should be less so on these ESG type of scores, more so on the process, more so on the thematics, and more so on ultimately the outcomes that are desired. Put that to its side, let's talk about some more of the bigger picture aspects, which is really where ESG climate type of beliefs are leaking into policy. We've already had some pretty significant wins with the Inflation Reduction Act. That basically locks in the next 10 years a significant type of progress here in the United States. Hopefully that'll continue to move forward as well. SEC's on the docket to be able to provide a final ruling. Hopefully that comes through. ISSB is obviously having some positive momentum. But what you've seen is now from the Inflation Reduction Act, some pushback from some Republicans on Manchin's new permitting legislation, which could have been a little bit more neutral, both for fossil fuels as well as for renewables. And I think certain people might have viewed that ultimately as a net benefit because of the need for large-scale transmission lines to be able to really push forward a lot of hydrogen type of plays and other renewables across the entire nation. So that type of combativeness, I think, is real. I think that's going to be continuing to grow for the short time being, and hopefully we won't see this necessarily persist too much further, and instead really focusing on the outcomes instead, whether it be on the policymaker side or whether it be on the investor side.
Thank you. A little bit longer than 1 or 2 sentences, Travis, but very well said. Mathieu, could you just quickly give us your thoughts, good or bad, on all the recent scrutiny around ESG?
Yeah, thank you. I'm not sure I'm going to be one sentence, but I think I think it's personally, I think it's a very positive development. I mean, if we want to be serious about ESG investing, we need information and data from private companies on sustainability issue. And what we're seeing in climate disclosure type of regulation is fundamental, and we need to get it right for everything else. Because if you want to do meaningful policies on carbon emission, you need that kind of information. If you want to create projects that are aligned with climate goals, you need that kind of information. So I think this is critical, and I think that's really good that's happening, because in the past we didn't have that information, and it's still lacking. Every company using different type of methodologies, and so data is not meaningful enough. I think that's really a key aspect that's being, and the ISSB, the International Sustainability Standard Board, is trying to get that kind of standardization, which I think is a very positive development. Second is really, if we talk about the risk return, and if we want to have sustainability and return going hand in hand, it's very important to have that kind of policy support that's gonna drive sustainable companies, make those more profitable, and gonna be making less sustainable companies less profitable. I think regulation and policies have a role to play there. And lastly, we need investors or asset managers and financial advisors to really consult their ultimate client about what they want their money to be invested in. And I think that kind of conversation is important, and we see a lot of development in that space as well, trying to make sure that those questions are asked to clients. When you have a financial advisor consulting with his client, to include that as part of the conversation, I think that's really key, because that's going to drive the demand for those products. That's making sure that basically the financial advisor is investing the money in alignment with the ultimate goals of their clients. So I stop here, but so I think a lot of positives coming out there.
All excellent points. I think we have time for one question from the audience. One question. Let's make it a really, really good one, if it's just one question. Right here in the front.
Hi, everyone. Taylor Anderson from DWS. I'll pick on Travis because I met him last week at the CII in person. So Travis, I'll start with you. And what I'm really curious about, you talked a lot about outcomes with regard to the investment process, right? We should be focusing on those outcomes. But specifically, when we're looking at SDGs and designing portfolios, which really is a lot of what I do for a living, the data is not perfect, but I'm just curious, the inputs that you're using now to create those outputs that are so important that you're talking about. So it seems like what you're saying, Travis, is pick the impact, pick the goal, but then what inputs are you using currently to design those types of portfolios?
Good question.
Yeah, first of all, the outcome, financial is number one, right? So your desired outcome, it has to really be that at the top. Then as far as the other type of inputs that we're looking at, let's go for private equity, for example. ESG Data Convergence Project is an initiative that CalPERS and Carlyle, 200 plus other GPs, LPs have signed on to. 2,000 different portfolio companies are now committed to be able to provide data on 6 different metrics. Are they the perfect metrics? Are they all inclusive? And is that the end of the line as far as all the data that you might want? No, but it's a start, and it's all relative to where the baseline was. The baseline was essentially zero, largely in a lot of the private markets. So if you're starting from a baseline of zero, do you go for perfection, or do you go for the incremental step forward to be able to start to build some type of thesis, build some type of understanding, and where to focus in on going forward? So you have renewable energy. Okay, if our goal is to actually increase renewable energy, and we can actually now have the portfolio companies start to report on renewable energy, the use of it or the lack of the use of it, then that could be LP pressure on GPs, GP pressure on the portfolio companies to be able to start to reconsider whether or not they have adequate use, or they're even making the right capital allocation type of decision. In many cases, renewable energy or certain PPAs for a lot of these industrial type of companies might actually be a good financial choice, let alone all the climate aspects to it. So those are the type of inputs that we're talking about to actually drive outcomes. I'll leave it there.
My last question, by a show of hands, who thought that was an excellent panel? Come on, fantastic panel, right? Let's give these panelists a round of applause. Great job. Thanks for spending some time. I know each one of you is very, very busy, and I hope all the audience benefited from their viewpoints.